Master the curriculum with StudyBuddy by Dr. Lay, independent of CFA Institute. Let's go.
Thanks for checking in with us today. You will find all of our conversation tied directly and accurately to the CFA curriculum. I am DigiJames, along with my co-host Dr. Lay's digital twin TalLe. Together, we will help you prepare for the exam thoroughly.
Hi everyone, it's great to have you with us. Today's episode is all about the why behind the markets. We're going to break down how inflation moves in tandem with the business cycle. And if you missed our deep dive on the phases of business cycles, definitely check that out for more context. We'll also decode how inflation actually hits your portfolio from cash and bonds to equity and real estate and equity. Finally, we'll connect the dots between government policy and the economic cycles we see today.
What would happen if you woke up tomorrow and your $100 bill only bought you a single slice of pizza? The number one reason candidates fail asset allocation isn't the math. It's forecasting bias, specifically assuming the future looks just like the present.
The CFA Institute loves to trap you on the reaction function because it explains why central banks act like nervous parents during a recession. If you don't understand how their bias toward fighting deflation shapes asset returns, you'll miss the justified points on the morning session.
It's like a thermostat that's great at cooling the house but sucks at heating it up. TalLe, the curriculum says we used to be tied to gold. What changed?
Historically, the money supply was dictated by specie, which is just a fancy term for physical gold or silver used in coins. Because the money supply was fixed to physical metal, periods of both inflation and deflation were incredibly common. Today, currencies are backed by the credibility of central banks, and we live in an era where everyone expects prices to trend upward.
So if I'm an investor, I'm basically pricing in a price hike by default?
Exactly, because persistent deflation is rare due to the central bank's reaction function, which is the technical way of saying how they respond to economic data. Central banks are much more effective at slowing down a hot economy than they are at jump-starting a dead one. This creates an inherent asymmetry where they fight downward demand pressure much more aggressively than they fight a booming market.
It's like trying to push a car up a hill with a wet noodle. It just doesn't work as well as hitting the brakes.
Precisely. And they fear deflation because it destroys debt-financed investments. In a deflationary world, your nominal income drops, but your debt stays fixed, making that mortgage feel like a massive anchor. Deflation also kills the power of central banks because interest rates hit the zero lower bound, leaving them with no room to cut further to stimulate growth.
So moderate inflation is actually the sweet spot for the economy?
Yes, moderate inflation is considered to have very modest costs compared to the absolute wreckage of deflation. Because of this, central banks target positive inflation, and investors build that expectation into every bond yield and asset price they touch. This expectation of positive inflation is the baseline for all capital market expectations in the curriculum.
Let's look for the secret in this part of the curriculum. The output gap. What is that really?
The output gap is the difference between what an economy could produce at full capacity and what it is actually producing. Inflation is procyclical, meaning it accelerates when that output gap closes at the end of a cycle and decelerates when a recession creates a large gap. If a central bank is credible, the average inflation rate over the whole cycle should hover right near their target.
So inflation is like the speed of a runner, sprinting at the finish line and gasping for air at the start.
That's a great way to see it, James. On the exam, if you are asked to explain the relationship of inflation to the cycle, you must mention that inflation lags the cycle, accelerating only after the output gap has closed. Understanding this lag is the key to not getting tripped up by short-term data noise.
All right, TalLe, let's get into the weeds. If inflation is procyclical, does that mean my expectations for inflation should just follow the same path? It feels like trying to track a roller coaster while you're sitting in the front car.
It's more complex than a simple tracking error, James. We have to differentiate inflation expectations by their horizon, which is just the length of time we're looking into the future. While short horizon expectations have roughly the same amplitude, the height of the wave as actual inflation, very long-term expectations should remain virtually flat. The stability only holds if investors maintain absolute confidence in the central bank's target.
So, if I'm looking at the intermediate horizon, I'm basically looking at a smoothie, a blend of the current cycle and whatever mess is coming next.
Precisely, because intermediate expectations blend the current phase with subsequent cycles. Their amplitude actually declines as the horizon gets longer. This creates a horizon structure of inflation expectations that is actually countercyclical. At the trough of a business cycle, the absolute bottom, this structure is upward sloping, but at the peak of the cycle, it becomes inverted.
Wait, so the inflation expectation curve looks like a mirror image of the economy?
Exactly, and this is a level 3 nuance you cannot miss. This countercyclical pattern in inflation expectations is a primary driver for why the yield curve, the graph of interest rates across different maturities, tends to be countercyclical as well. However, don't fall into the trap of thinking an inverted horizon structure guarantees an inverted yield curve. The term premium, or the extra pay you get for taking duration risk, is procyclical and can keep the curve from flipping.
Okay, let's pivot to the cash asset class. The curriculum says cash isn't the crumpled $5 bill in my pocket. What is it?
In this context, cash refers to short-term interest-bearing instruments like T-bills. If short-term rates adjust with expected inflation, cash becomes an inflation-protected asset with essentially zero duration, meaning its price doesn't change when rates move, earning a floating real rate. Central banks move the real rate on cash procyclically to stabilize the economy, making cash look like a superstar when rates are rising, but a dud when they are falling.
It's like a surfboard. It only works when there's a wave of rising rates to catch.
That's an apt analogy. Under deflation, cash can become exceptionally attractive if the zero lower bound is hit. That's the floor where nominal interest rates can't go much below zero. In that scenario, even if the nominal return is 0%, the real return is positive because the purchasing power of that money is growing as prices drop.
If I'm on the exam and they ask me to justify why cash is a good hedge during rising inflation, what's my line?
You must justify it by stating that cash has near zero duration and that central banks tend to increase short-term nominal rates procyclically to match or exceed inflation expectations, preserving the real rate of return. You are highlighting the floating nature of the return as the key mechanism.
GPS check time. We've covered how the horizon structure of inflation expectations is countercyclical and why cash acts as a zero-duration floating rate protector.
Well said. Let's continue our focus on the bonds versus stocks cage match and see how inflation moves the needle on fixed income and equity cash flows.
All right, we've got the cash under the mattress, or rather in T-bills. Now, let's talk about the heavy hitters, bonds and stocks. If inflation starts heating up, my bond portfolio is going to feel like a chocolate bar in a microwave, isn't it?
That is a visceral way to put it, James. For nominal bonds, the impact of inflation is transmitted strictly through the discount rate because the cash flows, the coupons and principal are fixed in nominal terms. When expected inflation rises, bond yields rise to compensate investors for lost purchasing power, which forces the price of the bond to drop, inducing capital losses. On the exam, if they ask you to determine the impact of inflation within the expected cyclical range, you must note that shorter-term yields will fluctuate more in percentage terms, but have less price impact due to their lower duration.
So short bonds are like a sports car. Lots of movement, but easy to stop. While long bonds are like a freight train that takes forever to change direction.
Precisely. However, the real danger is when inflation moves out of the expected range. If investors begin to reassess the long-run average level of inflation because the central bank loses credibility, long-term yields will skyrocket, leading to massive capital losses for long-duration holders. Conversely, persistent inflation is a peculiar beast. It actually benefits high-quality bonds because it increases the purchasing power of those fixed cash flows. But watch out, deflation simultaneously impairs the creditworthiness of lower quality high-yield debt because the borrower's nominal income is shrinking while their debt burden remains constant.
Okay, let's talk stocks. I've always heard stocks are a natural hedge for inflation because companies can just raise prices. Is that the CFA gospel?
It is more nuanced than that. As long as inflation stays within the expected cyclical range, it's largely a wash for stocks. This is because both the expected future cash flows, like dividends and earnings, and the discount rates used to value those flows tend to rise or fall in tandem with the horizon structure of inflation expectations. The level 3 trap here is assuming stocks are always a hedge. If inflation breaks out of the range, it signals a threat. Unexpectedly high inflation suggests the central bank will have to slam on the brakes to slow the economy, which hurts growth.
So if inflation gets too hot, the central bank becomes the party pooper and kills the stock market rally.
Exactly. Within the equity market, you must be able to distinguish between winners and losers. Firms with pricing power, the ability to pass along rising costs to customers, perform best during high inflation. On the flip side, deflation is a nightmare for asset-intensive, commodity-producing, or highly leveraged firms because the value of their assets and products is dropping while their debt remains a fixed nominal weight.
It sounds like deflation is basically economic kryptonite for anyone with a lot of machinery and a big loan.
That is a very apt mental model. To justify a stock's performance in your essay, you have to look at the firm's cost structure and debt levels. If the question mentions a highly leveraged firm in a deflationary shock, your logical conclusion must be that their credit risk is spiking and their equity value is likely cratering.
GPS check. We've learned that bonds hate unexpected inflation because of the discount rate hit. And stocks are okay with moderate inflation, but hate the breakout extremes on either side.
Ready for the next segment? We're going to look at real estate and then dive into a specific case study involving Kezia Jabari and her inflation fears.
All right, TalLe, let's talk about real estate. I always think of property as the ultimate safe haven. You've got the land, you've got the bricks. It feels like a fortress against inflation. But I'm guessing the CFA curriculum has a way of poking holes in my fortress.
It's not quite a hole, James, but more of a timing mismatch you have to account for in your analysis. Real estate is unique because its cash flows, the rental income, are often dictated by existing leases. If inflation stays within the expected range, the renewal of those leases usually allows rental income to rise in step with inflation, keeping asset value stable. However, the speed of adjustment is the variable that matters most. If you're locked into a 10-year lease with no inflation adjustment, you're essentially holding a bond with a fixed coupon while your maintenance costs are skyrocketing.
So if I'm the landlord, I'm basically playing a game of musical chairs with my lease expiration dates?
Precisely. Higher than expected inflation actually coincides with high demand for real estate, which creates an expectation that rental income will eventually rise even faster than general inflation, pushing property values up. And this is the analytical deep dive the CFA wants. It's highly idiosyncratic. You must consider the length of the leases, the supply of similar properties, and whether new buildings are hitting the market right when your leases come up for renewal. Conversely, unexpectedly low inflation or deflation puts massive downward pressure on rental income and property values, especially for less than prime properties that have to slash rents just to avoid being empty.
Let's look for the secret in this part of the curriculum, the Kesia Jabari example. She thinks a surge in inflation is coming because of quantitative easing, which is just the central bank printing money to buy assets, and she's worried. If the market agrees with her, what happens?
If the market shares her view, the outcome is relatively normal because it's priced in. Short-term rates and bond yields will rise as expectations adjust. The yield curve should actually flatten because long-term inflation expectations stay anchored by the central bank's credibility. In this scenario, floating rate instruments, our cash, become the belle of the ball. Interestingly, the belly of the curve, those intermediate term bonds, are actually the most vulnerable because they lose the protection of short-term rate resets but don't have the long-term anchoring of the 30-year bond.
But what if the market panics? What if they stop believing the central bank can keep the genie in the bottle?
That is the nightmare scenario B in the curriculum. If the market doubts the central bank's ability to contain inflation, long-run inflation expectations de-anchor and rise. Instead of flattening, the yield curve may steepen as the longest maturities, the 20 and 30-year bonds, get absolutely hammered. Stocks will likely suffer because the market expects the central bank to eventually get aggressive and trigger a recession to stop the bleeding. And here is a specific detail for your justify answers. Real estate with long-term leases and little debt will suffer, but real estate with substantial long-term fixed-rate debt actually does well because the landlord is paying back those loans with cheaper inflated dollars.
GPS check. We've realized real estate is a hedge if you can reset leases or if you have fixed debt in a high inflation world. We also saw how market credibility determines if a yield curve flattens or steepens when inflation spikes.
Sounds good to me. Now let's look at the Taylor Rule, the mathematical heartbeat of how central banks set interest rates.
All right, TalLe, it's time for the Taylor Rule. I always imagine this as the dashboard for a central banker. It's got a few dials, and if they turn one, the interest rate needle jumps. But since it's math, I'm guessing it's not just for fun, it's a target, right?
Exactly, James. The Taylor Rule is a framework used to determine the target nominal policy rate based on how far the economy is from its ideal state. Think of it as a balancing act between growth and inflation. The formula essentially says your target rate should be the sum of the neutral real rate, the expected inflation, and then two adjustment pieces. These adjustments are 0.5 times the output gap, how much growth deviates from trend, and 0.5 times the inflation gap, how much inflation deviates from the target.
So, if the economy is running hot, with growth 1% above trend and inflation 1% above target, the central bank doesn't just raise rates by 1%. They have to do a little extra math dance.
Precisely. Watch when the red line, inflation gap, and the blue line, output gap, are both high. The black line, interest rate, in the bottom chart doesn't just rise, it surges. This is the central bank slamming the brakes because the economy is failing both tests at once. When the blue line dips below zero, a negative output gap or recessionary signal, watch how the black line drops quickly. The Taylor Rule tells the bank to ease up on the brakes to help the economy recover, even if inflation is still slightly elevated. Even if both gaps were zero, the rate wouldn't be zero. It would sit at 4%, 2% neutral rate plus 2% inflation. This is the ideal state where the economy is in perfect balance.
We've got the concepts down, but if the CFA examiners throw a math problem at me using the Taylor Rule, I don't want to be staring at my calculator like it's a foreign language. How do we actually solve for that target rate?
It is all about the reaction function math, James. Another way to describe the formula is that determines the target nominal policy rate by starting with the neutral real policy rate. That's the rate that neither helps nor hurts the economy, and then adding current expected inflation. But then we have to adjust for the gaps. We add half of the output gap, how much growth is above or below trend, and half of the inflation gap, how much inflation is above or below the target.
Okay, let me try a mental model with some random numbers. Let's say the neutral real rate is 1.5% and the target inflation is 2.0%. But things are getting spicy. Growth is at 4% when the trend is only 3% and inflation is sitting at 3.5%.
Perfect scenario. First, let's identify your gaps. Your output gap is 1.0%, the 4% actual growth minus the 3% trend. Your inflation gap is 1.5%, the 3.5% actual inflation minus that 2% target.
So if I'm the central banker, I start with my base. I take the 1.5% neutral real rate and add the 3.5% current inflation. That's 5.0% as my starting point?
Now for the adjustments. You take 0.5 times your 1.0% output gap, which is 0.5%. Then you take 0.5 times your 1.5% inflation gap, which is 0.75%. Add those to your 5.0% base, and your target nominal policy rate is 6.25%.
Wow, so if that inflation gap gets wider, my final result grows even faster because the Fed is pulling the string harder to tighten the economy. But wait, is this just a plug-and-play formula on the exam?
That is the Level 3 trap, James. The curriculum explicitly warns that none of these inputs, like trend growth or the neutral rate, are objectively observable. They are all estimates. On the exam, if they ask you to justify why the Taylor rule might not perfectly predict the next move, you must mention that policymakers have to use judgment to decide which models or horizons to use for these expectations.
Got it. It's a framework for the thrust of policy, not a rigid law of physics. If the numbers change, the direction of the interest rate follows the gaps.
Correct. And if you're asked to formulate the real policy rate instead of the nominal one, you just move expected inflation to the other side. The real target rate is just the neutral rate plus those two half-gap adjustments. None of these inputs, trend growth, the neutral real rate, or even expected inflation, are sitting on a shelf waiting to be read. Analysts have to use substantial judgment to estimate them. This is why the investment community scrutinizes every single word in a Federal Reserve statement. They aren't just looking for the rate, they are looking for the signals that reveal how the Fed's own reaction function is shifting.
If I'm an analyst, I'm not just a mathematician, I'm a Fed whisperer trying to figure out which version of trend growth they are using in their model.
Exactly. To justify an interest rate forecast on the exam, you can't just cite the Taylor rule. You must mention the uncertainty in the inputs, like the neutral real rate or the output gap. With that, we just mastered the Taylor rule math. Add the neutral rate, the expected inflation, and half of both the growth and inflation gaps. Now let's look at Albert Grant and his deflationary shock scenario. If growth is 1% below trend and inflation is 2% below target, both monetary and fiscal policy should respond countercyclically. Monetary policy will cut rates, while fiscal policy uses automatic stabilizers like lower tax takes and higher transfer payments to cushion the blow.
We've mastered the Taylor Rule balancing act and realized that central banks use it as a guide, not a rigid law, because the inputs are all estimates.
That's right, James. We're going to wrap up with the supply shock versus demand shock debate and how that changes everything we just talked about.
All right, TalLe, we've spent the whole day acting like inflation only moves because people are buying too much stuff. But what happens when the world just stops working right? Like an oil crisis or a global shipping meltdown. That sounds like a different kind of headache.
You are touching on a critical distinction between demand pull and cost push dynamics, James. Most of our discussion assume the short-run aggregate supply curve is upward sloping and the cycle is driven by aggregate demand. This is why we say inflation is procyclical. It moves in the same direction as the economy. However, if aggregate supply shocks predominate, the entire logic flips, and inflation becomes countercyclical. This creates the dreaded stagflation, where the economy is shrinking but prices are skyrocketing simultaneously, much like the 1970s oil crisis.
So instead of a runner gasping for air at the start, it's like a runner trying to sprint through a waist-deep swamp. Everything slows down, but the effort, the cost, is through the roof.
That's a perfect mental model for a supply shock. On the exam, if they ask you to discuss a scenario where inflation is rising while GDP is falling, you must identify this as a supply-side shock. In this environment, the central bank is in a lose-lose situation. If they raise rates to fight inflation, they kill the already weak growth. If they cut rates to help growth, they fuel the inflation fire. This is the exception to the rule that can absolutely wreck a standard procyclical portfolio strategy.
Let's look for the secret for this part of the curriculum: the policy lag. We talk about central banks like they have a remote control, but it feels more like they're steering a giant tanker ship with a 10-mile delay.
You've nailed the long and variable lags problem. Monetary policy is countercyclical in intent, but there is a massive risk that the central bank's measures will actually exacerbate the cycle instead of moderating it. This risk is highest at the top of the cycle. The central bank might overestimate the economy's momentum and keep rates high for too long, accidentally triggering a deeper contraction than they intended.
And then they try to fix it by pushing on a string? That sounds like a classic Level 3 analogy.
Exactly. The curriculum explicitly uses that phrase. Expansionary policy is like pushing on a string, while restrictive policy is like pulling on a string. Pulling tightening works effectively to slow things down, but pushing easing rarely suffices to turn a contraction into a strong recovery on its own. For the morning session, if you are asked to justify why a central bank is struggling to end a recession, you should mention this asymmetry in policy effectiveness.
GPS check. We've learned that supply shocks make inflation countercyclical, the stagflation trap, and that central banks have a much easier time stopping a party than starting one because of policy lags and the string analogy.
We've covered the framework, the asset classes, the Taylor Rule, and the policy pitfalls. If you understood this portfolio breakdown, you're going to need our deep dive on yield curve strategies to pass the morning session. Understanding the reaction function is the difference between guessing and determining the right asset allocation. If you can't justify why a central bank is pushing on a string, you aren't ready for the exam. Master the lag, master the cycle. James, let's recap our session for today with critical takeaway.
That's the plan. TalLe, we can't let them walk into the gym or their commute without the big picture summary. A candidate needs to synthesize all these macro signals into one coherent market view before they hit the exam hall.
Precisely, James. Let's do a rapid-fire recap of the logic that will save your score when the clock is ticking in the morning session. First, remember the central bank bias. Modern central banks favor moderate inflation over deflation because deflation destroys debt-financed investments and renders interest rate tools useless at the zero lower bound.
It's like they have a favorite child. And what about that procyclical rule? Inflation is like the economy's shadow, right?
In a way, yes. Inflation typically accelerates at the end of the business cycle as the output gap closes. Consequently, inflation expectations are procyclical, but their amplitude or the intensity of the swing decreases as your investment horizon gets longer. This leads to the horizon structure, which is a counter-cyclical expectation curve that's upward sloping at the bottom of a recession and often inverted at the peak of a boom.
Okay, Let's break down the winner's circle for the asset classes. If I'm holding cash, I'm basically looking for a floating real rate, right?
Exactly. Cash is a relative winner in inflation because it earns a floating real rate as central banks hike nominal rates procyclically. It's also a winner in deflation because it becomes particularly attractive if rates hit zero, as the real return becomes positive while prices fall.
But bonds are a different story. They're the moderate losers when inflation heats up because those fixed coupons lose value as discount rates rise, causing capital losses.
Correct. Though high-quality bonds become winners in persistent deflation because the purchasing power of those fixed flows increases, even if credit risk spikes for lower quality debt. Stocks, meanwhile, tend to be neutral in expected inflation because cash flows like earnings and discount rates usually rise together, offsetting each other. However, stocks are major losers in deflation, which is especially detrimental for asset-intensive or highly leveraged firms as asset values drop while debt remains fixed.
And real estate? That's my inflation hedge, as long as I can keep the rent coming in.
It is a hedge because rent increases can offset inflation, specifically for properties with short lease renewal cycles. But it's a loser in deflation. Property values fall, and less than prime properties face high vacancies as they struggle to cut rents enough to keep tenants.
If you understood this portfolio breakdown, you're going to need the next video on yield curve strategies to pass the morning session. Subscribe so you don't miss the next module. And don't forget the Taylor Rule. That's the math that ties it all together.
Correct. The Taylor Rule is your formula for the Target Nominal Policy Rate. It's the neutral real rate plus expected inflation adjusted by 50% of the growth gap and 50% of the inflation gap. If growth or inflation is 1% above target, the central bank should raise the policy rate by 0.5% above the neutral path for each. On the exam, remember that this rule is a framework, not a law, because inputs like trend growth are estimates, not facts.
And the level 3 secret one last time. The central bank is a parent with a brake pedal, not a magic wand. They can pull the string to stop inflation, but they often struggle to push the string to start growth. Before we roll the credits, let's make sure this isn't just dry theory. Imagine you're at the finish line of the CFA marathon. You're tired, your brain is like overcooked pasta, and then, bam! An essay question hits you. Discuss the impact of a negative supply shock on a portfolio of nominal bonds and equities.
James, that's not a question, that's a horror story for the unprepared. But here's the intellectual deep dive you need to survive it. In a supply shock, the rules of the game are inverted. Normally, inflation is procyclical. It goes up when the economy is booming. But in a supply shock, inflation becomes countercyclical. It rises while growth collapses.
So it's like being stuck in traffic during a heat wave. You're not moving, but the temperature just keeps climbing.
Exactly. And for your portfolio, it's a double whammy. Nominal bonds get crushed because inflation expectations are rising, forcing yields up and prices down. Meanwhile, equities get hammered because input costs are rising, squeezing margins while the overall economy is shrinking, killing sales. On the exam, if you are asked to justify why a diversified portfolio failed during a supply shock, you must mention the positive correlation between bond and stock price declines in that specific regime.
That's a trap that could catch a lot of people off guard. It's like thinking your umbrella will protect you in a flood. Sometimes the whole environment just changes too fast.
Precisely. And don't forget the Taylor Rule math. If you see growth falling by 2% and inflation rising by 2%, the reaction function is paralyzed. The math tells the central bank to hike and cut at the same time. That's why these periods lead to massive market uncertainty.
Okay, I'm feeling the adrenaline now. We've covered the reaction function, the output gap, and why pushing on a string is the ultimate central bank frustration.
You've got the tools, James. To the candidates, don't just memorize the table, understand the mechanics of the shifts. If you can explain why a central bank fears deflation more than moderate inflation, you've already won half the battle.
If you understood this macro breakdown, you're going to need the next video on yield curve strategies to pass the morning session. That's where we take these inflation views and turn them into actual trades. Subscribe so you don't miss the next module.
Study hard, stay analytical, and remember, the curriculum is a map, but your logic is the compass.
See you at the finish line. Bye for now.